Hello students. In this video we shall study what is activity ratios. Till now we have finished two types of ratios, which is our liquidity ratios and solvency ratios. Now this is the third type called as the activity ratio. Now basically activity ratios are ratios that tell us the performance. They help us to judge the performance of the company, the capacity of the firm, that how the firm can handle its own activities. Okay, we can judge with the help of all these ratios. We can judge or measure the performance of the firm, how well the firm is able to utilize its resources. So let's first do the first type. The first ratio in an activity ratio is trade receivables turnover ratio. Now, this ratio is activity ratios are expressed in the times form. If you remember, I have taught you there are the different ways of expressing the ratio. So you will express it in the times form. So the trade receivables turnover ratio is credit revenue from operations upon average trade receivables Now, what is average trade? Okay, first we'll go with what is credit revenue from operations. The word credit revenue from operations is nothing but revenue means your sales. So, whatever your credit sales are means your credit revenue from operations. So, in accounting language, revenue means sales, and these are your credit sales. And what are your trade receivables? I need my average. What are my trade receivables? Trade receivables are average of debtors and my bills receivables. Got it? So it's just a simplified names of the formula. So it's credit revenue from operations and average of trade receivables. Now, how do I get my credit sales? The formulas which might be relevant to this one will be total sales. Sometimes they might give me total sales. Total sales are made up of cash sales and credit sales. So the formula relevant over here will be total sales is equal to cash sales plus credit sales. So I might be given total sales and cash sales. So I can just subtract and get my credit sales. Okay. And another relevant formula which you might use over here will be cost of goods sold. Cost of goods sold. Now, in your 11th standard, you have done this cost of goods sold. There was a formula which you learned. We also write it in the short form as COGS, cost of goods sold. I might use that short form in my later videos. So, cost of goods sold, in this particular, generally the formula was opening stock plus purchases plus direct expenses minus closing stock will give me cost of goods sold. But here also you can use the formula sales, the other formula which will be relevant for this, sales minus gross profit. This is the formula for cost of goods sold. So they might give you cost of goods sold and they might give you gross profit. So you can get your sales, but this will give you total sales. Next is, how do I find my average trade receivables? How do I get? I need to find the average. So trade receivables itself is made up of debtors and bills receivable. What will I do is I will first find the average of debtors. So you have learned the meaning of average in your younger standards. So basically average is your opening trade receivables plus closing trade receivables upon 2. So you just add the opening balances and add the closing balances upon 2. Trade receivables may you can include your debtors and bills receivable. So this is how you will find your average trade receivables. Supposing nothing is mentioned, you are just given one value of your debtors and BR, then you will just consider it that it is an average. You will just add the two. Let us see our first illustration in your TS Grewal textbook. It is illustration 61. So you can just see the information. Let me just write the information. Before starting the sum, there is another important line which you need to underline from your textbook, that when you all are calculating this ratio, you should not deduct the provision for doubtful debts from the amount of trade receivables. You are not supposed to deduct the provision for doubtful debts from your trade receivables. So now let's proceed with the illustration. I have been given credit revenue from operations as 9,60,000, gross debtors as 1,90,000. I've been given BR, bills receivable, as 50,000, and I've been given provision as 10,000. Now I have to find my trade receivables turnover ratio. So trade receivables turnover ratio, I'm writing my short forms. So here it is nothing but credit revenue from operations, which is nothing but your credit sales upon average of trade receivables. Now what is my credit revenue? My credit revenue is 9,60,000. It's given to me in the sum. I want to find my average of trade receivables. Now, as I mentioned earlier, that if you are not given the opening and the closing, you consider these as your average numbers given to you. So now I am not supposed to deduct the provision for debtors. So what is my trade receivables? Trade receivables will be debtors plus bills receivable, which is 1,90,000 plus 50,000 gives me 2,60,000. Sorry, 2,40,000. Now I will go up and feed. Now when I divide 9,60,000 by 2,40,000, I get the answer 4. I will represent my ratio as 4 times. I will represent my ratio as 4 times. So this indicates the number of times in a year I have received the amount from my debtors. The number of times I received the amount from my debtors. Uh, the higher the ratio is considered better, because I am able to recover my money from my debtors faster. A higher ratio is considered to be good. If a ratio is less, means I'm taking a lot of time to recover my money from my debtors. So understand, what does this ratio help me out? How many times in a year am I able to recover the money from my debtors? That is the purpose of the ratio. I hope the concept is clear in this video.